Is Hantavirus the next COVID? Will glove stocks soar again? Should you start buying? Something quietly shifted in the markets this week. Not a rate hike, not an earnings miss, not the kind of headline that makes the front page of the Financial Times. It was a virus. Not COVID, not the flu, something older, something most people had completely forgotten about. And yet, in the span of a few trading sessions, certain stocks in Malaysia began to move. Some investors quietly started paying attention. Others started asking questions they hadn't asked in years. So the question is, should you be paying attention too? Let's go back to the beginning. Hantavirus is not new. It has existed for decades, quietly circulating in rodent populations across multiple continents. The first major outbreak that caught global attention was in the United States in 1993, the Four Corners region, a cluster of unexplained deaths, young, healthy people, and then a virus no one had properly cataloged before. It was named Hantavirus, after the Hantan River in South Korea, where a related strain had been identified decades earlier. The virus spreads primarily through contact with infected rodents, their droppings, urine, saliva. It does not spread easily between humans. That distinction matters enormously when we start talking about markets. But here's what people sometimes forget. Markets do not always respond to facts alone. They respond to perception, to fear, to the memory of what happened last time the word outbreak appeared in a headline. And the memory of COVID-19, in Southeast Asia especially, is still very much alive. The supply chain disruptions, the border closures, the sudden violent rotation in equities, glove stocks going parabolic, tourism stocks collapsing overnight. That memory does not disappear easily. So what exactly has been reported? As of 14th of May 2026, the Hantavirus cluster linked to the MV Hondias cruise ship has resulted in at least 9 confirmed cases and 3 deaths across multiple countries. The World Health Organization, WHO, has assessed the global risk as low, but warns the situation could change. Malaysia's Ministry of Health has confirmed no local cases, but has tightened border health checks and activated PCR diagnostic capacity. The case fatality rate is estimated at 38%. The strain involved is the Andes virus, which is the only hantavirus known to allow rare, limited human-to-human transmission. These are the facts as they stand today. And facts matter, because without them, you are not investing. You are reacting. What we do know is this. The news cycle has picked up the story. Search trends have spiked. And in Malaysia, that pattern has a well-documented history of moving specific sectors of the KLCI, even before the fundamentals justify it. Let us talk about what is actually moving and why. The first place investors look almost reflexively is gloves. Top Glove, Hartalega, Supermax. These 3 names became household words during COVID-19. Their share prices went on runs that most retail investors had never seen before, and in many cases, had never recovered from either. The crash that followed was equally historic. Now, with any new outbreak narrative entering the market, the question comes back. Could it happen again? As of 14th May 2026, glove stocks in Malaysia surged on outbreak-driven sentiment. Top Glove closed at 83 cents, Hartalega at 1 ringgit and 34 cents, and Supermax at 34 cents. Trading volumes on these counters were unusually high, with Top Glove the most actively traded stock on Bursa Malaysia. Here's the nuance that matters. Hantavirus does not spread the way COVID-19 did. The demand thesis that drove glove stocks to extraordinary heights was built on a specific set of conditions. A pandemic with global human-to-human transmission, overwhelmed healthcare systems, and a complete disruption of global supply chains. Those conditions do not currently exist with Hantavirus, but perception and fundamentals do not always move together, at least not in the short term. Beyond gloves, healthcare stocks more broadly are drawing attention. IHH Healthcare, KPJ Healthcare, Pharmani Yaga. Any company positioned to benefit from elevated health awareness or increased government health spending becomes part of the conversation. And then there is the other side of the trade. Tourism, hospitality, airlines, sectors that bled badly during COVID-19 and have only recently begun to recover. Any sustained outbreak narrative, even an overstated one, carries the risk of denting consumer confidence in travel. The Malaysian tourism sector, which contributes significantly to GDP, watches these headlines very carefully. As of 14th of May 2026, the FBM KLCI closed at 1,745.58, slipping slightly from the previous session. Analysts describe sentiment as cautiously watchful, with investors monitoring outbreak headlines but not pricing in systemic risk. The market is not panicking, but it is watching. So what should a rational investor actually do with all of this? First, do not let the news cycle do your thinking for you. Outbreak narratives create emotional noise, and emotional noise is where poor investment decisions are made. The investors who made lasting gains during COVID-19 were not the ones who panic-bought gloves at the peak. They were the ones who understood the mechanism, sized their positions accordingly, and had an exit thesis before they entered. Second, watch the data, not the headlines. Transmission rates, government response classification, WHO advisory levels. These are the variables that determine whether a localized health event becomes a macroeconomic one. Right now, Hantavirus does not carry the transmission profile that would justify a systemic market re-rating. But that assessment should be revisited as new information emerges. Third, understand the difference between a trade and a thesis. A short-term spike in glove stocks driven by fear-based buying is a trade. A fundamental re-rating of the healthcare sector based on a sustained shift in global health spending is a thesis. These require different time frames, different risk tolerances, and very different exit strategies. And fourth, position sizing always matters more than stock picking. Even if your directional call is right, being overexposed to a single sector during a volatile news cycle can do significant damage to a portfolio before the narrative resolves. Markets have a long memory. They remember every outbreak, every fear cycle, every moment when rational analysis gave way to instinct, and the prices that followed. The story of hantavirus in Malaysian markets is still being written. The next chapter depends on data we do not yet have, but informed investors do not wait for certainty. They build frameworks that can absorb new information without losing their footing. If this kind of analysis is useful to you, subscribe and drop a comment below. Are you watching the healthcare sector right now? What's your read on this?